and bear are typically used to describe how stock markets are performing, whether they are appreciating or depreciating in value. In this context, a rising market is called a bull market, while a declining one is called a bear market. Given that the crypto market is generally volatile and fluctuates on a daily basis, these terms are used to refer to longer periods of either mostly upward or downward movement. Likewise, changes in markets are indicated by substantial swings, at least 20%, in either direction. In this article, we'll focus on how these trends apply to cryptocurrency. Specifically, we'll discuss, what is a bull or bear market? What characterizes bull versus bear markets? How to know whether we are in a bull or bear crypto market? The key differences between bull and bear market, and how to invest in a bear versus bull market. What is a bull market? A bull market refers to generally favorable economic conditions. It means that a market is on the rise and is also usually accompanied by positive investor sentiments concerning the current uptrend. There is a sustained increase in asset prices in a bull market, accompanied by a strong economy and high employment levels. This applies to cryptocurrency markets as well as traditional markets. In cryptocurrency, however, it is more common to see stronger and more consistent bull run crypto phases. What is a bull run in crypto typically like? A 40% increase in price over 1 to 2 days is quite the usual scenario. This is because crypto markets are relatively smaller than traditional markets and are, therefore, also more volatile. The term bull market is believed to have originated from a bull's fighting style, wherein it attacks its opponents with its horns in an upward motion. Today, a bullish market or investor usually connotes optimism concerning an asset's continued rise in value. In the crypto market, the charging bull heralds a bullish phase for cryptocurrencies. Here, you'll observe cryptocurrencies growing in value with generally favorable economic conditions and optimistic investors looking to make the most of their rising crypto portfolios. Briefly put, the investor starts bull markets through the purchase of securities. This can also be done with fiat currency, as bullish markets typically raise the price of securities. The bull market goes on for as long as supply is exceeded by demand. After a while, the bull gets tired, so to speak, and the market shifts and turns into a bear market. What causes a bull market? As previously mentioned, investors are the ones who begin a bull market. When they feel that prices will start to rise and continue doing so for an extended period, they start buying stocks, at a low price, and are optimistic about their return on investment, ROI. The increased optimism among investors likewise causes stock prices to continue rising. There are also other factors that cause a bull market to emerge. Among these are a strong gross domestic product, GDP, and low unemployment rates. Generally, favorable market conditions cause an increase in investors' confidence. Cryptocurrency bull markets are, likewise, influenced by similar factors to traditional markets. However, crypto markets are still relatively new on the scene, compared with traditional securities which have been around for hundreds of years. With fewer total investors, crypto may also be driven by factors unique to its niche. For example, crypto bull runs may be driven by things such as mainstream and pop culture support. Think of the 2017 bull runs influenced by the likes of Paris Hilton and DJ Khaled, and shows like The Big Bang Theory. Introduction of institutional capital. A good example is MicroStrategy's $650 million Bitcoin, BTC, investment, over 70,000 BTC. Growing optimism from traditional finance. JP Morgan strategists said Bitcoin could rally to as high as $146,000. Unique events that threaten traditional finance. COVID-19, for example, drove a lot of people to turn to crypto amid the stress caused by the pandemic on traditional financial markets. Characteristics of a crypto bull market. The typical attitudes and actions that characterize a bull market are: increased prices over a sustained period of time, strong demand despite weak supply, increased investor confidence in the market, overpricing of certain projects, insertion of talks about cryptocurrency in mainstream media as well as social media. General interest in cryptocurrency among celebrities, influencers, and other sectors who might not have been interested in crypto before. Hard rise of prices in the event of good news. A slight drop in prices in the event of bad news. What is a bull run in crypto? A bull run refers to an extended period during which a lot of investors are purchasing cryptocurrencies. It's characterized by the above-mentioned characteristics such as rising prices, demand outweighing supply, and high market confidence. Investor confidence typically drives a positive feedback loop, further extending the bull run, more investments, continued rise in prices. For cryptocurrency, most especially, the price of a given cryptocurrency is largely influenced and driven by public confidence in an asset. What is a bear market? On the other hand, a bear market is one in which the value of cryptocurrencies has fallen by at least 20% and is continuing to fall. An example includes the famous cryptocurrency crash in December 2017, when investors saw Bitcoin fall from $20,000 to $3,200 over the course of a few days. A declining bear market is characterized by a dip of 20% or more coming from previous highs. As such, prices are low and dropping continuously. The downward trend likewise affects investors' outlook and perpetuates a further downward pattern. The term bear is believed to have come from a bear's fighting style, starting high, then attacking with claws downward and all its weight pushing down. During a bear market, the economy is slow with high unemployment rates. These conditions can arise from poor economic policies, geopolitical crises, burst market bubbles, and even natural disasters. Bear markets also lack the general optimism and confidence that most investors have during bull runs. Typically, crypto traders aim to purchase assets during a bear market, especially during rock bottom. However, it can be hard to know exactly when a bear market has ended, making it hard for investors to take the gamble and purchase low-value crypto that may or may not recover. Prices typically drop the moment the market receives news concerning unfavorable conditions regarding a particular cryptocurrency or stock. The downward spiral causes more people to hold off on investments due to the belief that more bad news will come soon and that there's a need to brace themselves for the worst. Some even sell their holdings out of panic, further creating a downward trend. Bear markets tend to calm down eventually, and investors slowly gain confidence, starting a new bull cycle yet again. What causes a crypto bear market? A downward trend in pricing can typically cause a bear market to begin. As prices continue to drop, investors simultaneously lose confidence that prices will recover, resulting in further downtrends. In general, things such as wars, political crises, pandemics, and slow economies may trigger the start of a bear market. Government intervention may also cause a bear market to begin. In crypto, however, it's much harder to predict when a bear market will start based on previous trends. Whereas the stock market already has decades of data for investors and analysts to refer to, the crypto market is relatively young. While the causes of a bear market vary, there are a few common indicators that a bear market is going to start. Some of the indicators of an emerging crypto bear market are lower trading volume. This usually means that people have started to hold their coins due to uncertainty in the market. Negative sentiments from traditional finance. An example of this was when JP Morgan CEO Jamie Dimon called Bitcoin a fraud in 2017, just months before it reached $20,000 per unit and then crashed promptly. Death cross, a technical indicator pertaining to an asset's crossing from a 50-day moving average to a 200-day moving average. Backwardation, when an asset's price in the futures market is lower than the current market price. Changes in the federal funds rate, the rate at which banks lend/borrow their excess reserves overnight. Intervention from regulatory bodies. An example of this is the Chinese government's restrictions concerning crypto software and mining. Such interventions force a lot of mining operations to go offline, causing widespread uncertainty. Characteristics of crypto bear markets. The typical attitudes and actions that characterize a bear market are: decreasing prices over a sustained period of time. Supply is greater than demand. Lack of investor confidence in the market. No talk, or negative talk, of cryptocurrency in mainstream media as well as social media. General distrust in cryptocurrency among economists, analysts, and traditional finance. Lower highs in the event of good news. Lower lows in the event of bad news. Bull versus bear market, key differences. So, the question a lot of people ask is, how do you determine if it's a crypto bull or bear market? Although both are marked largely by the direction of cryptocurrency prices, there are key differences that investors can take note of. The effect that bull and bear market trends have on cryptocurrency is generally the same as that of stocks. With cryptocurrency, however, trends differ due to crypto's susceptibility to fluctuations. As such, crypto markets tend to move faster as soon as bull or bear market trends take hold. Bull and bear markets are also easier to spot in stocks. It may not be the case with cryptocurrency since crypto investors give feedback that affects crypto differently as compared to stocks. For example, let's say that crypto markets are recovering from a bear market. As such, an investor would then typically enter bull investor mode at the bottom of a bear market. Consequently, this will drive up crypto prices much faster. Crypto bull markets tend to move quickly compared to stocks. They also tend to be shorter lived, lasting only between a few days to a month. Then, as the bull market continues to grow stronger, investors will then slowly decline because they are likely selling the currency and cashing out. For this reason, bull and bear markets affect crypto in a different way to stocks due to their added volatility and the speed of exchanges. Some of the notable differences between bull and bear markets are: supply and demand. In a bull market, demand for cryptocurrencies is strong amid weak supply. A lot of investors want to buy crypto, but few are willing to part with them. This drives up prices further as investors compete to purchase what is available. In a bear market, however, more people are selling than buying, as opposed to the investment principle. Demand is lower than supply, causing prices to drop further. Market scenario: rising GDP ushers in a bull market, while falling GDP signals the emergence of a bear market. Increases for companies and rising salaries for employees. If you want to buy Bitcoin or other cryptocurrencies, click the link below.